Have you ever considered the most dangerous seat at a party? The one just taken by the last guest to arrive in the loudest room. The music is at its peak. The glasses are full. Everyone is smiling. You arrived late, but the mood feels safe. The bill lands in front of the last person to walk in. January 30th, 2000. 88 million Americans were watching the Super Bowl. A sock puppet appeared on screen. An ad for Pets.com, an online pet supply store. 30 seconds. $1.2 million. Investors watched and concluded, any company that runs a Super Bowl ad must be real. 2 weeks later, it went public. Everyone lined up. 9 months later, it was gone. The stock fell to 2% of its offering price. Amazon had invested. Venture capital followed. It appeared on the Super Bowl. Everyone was certain. The moment it became most famous was the moment the bill arrived. That same year, the Nasdaq shed more than 3/4 of its value in 2 years. $5 trillion gone. But most of those who rode the peak had not decided alone. Everyone was moving in the same direction. We believe the path most traveled is the safest. In asset markets, something strange happens. The moment the most people converge, that place becomes the most dangerous. This is not a history of the dot-com bubble. This is about the structure that always brings people in at the end. The belief is not wrong. Hundreds of thousands of years of history confirm it. When people are running in one direction on an unfamiliar road, follow them. The long line outside a restaurant usually means better food. In uncertainty, following the majority is not foolishness. It is the algorithm evolution selected. Asset markets run on different rules. This is not an attack on capitalism. It is an exposure of the mechanism that makes prices. In asset markets, the moment a majority moves in the same direction at once, that movement itself becomes the price. When the price rises far enough, the price calls in the next majority. The majority does not fail because they were wrong. When the majority moves at once, the movement becomes the price. The price creates the next majority. When that cycle ends, the last one in receives the bill. Supply in asset markets does not expand on demand. Shares cannot multiply overnight. Buildings cannot be built instantly. When demand explodes, the first to react is not supply. It is price. The risen price summons demand again. This dynamic is what fundamentally separates asset markets from all others. This bubble runs on 3 gears. First, the instinct that makes a crowd feel safe. Second, the structure that mistakes others' actions for information. Third, the loop where risen prices manufacture certainty. Let us examine each. The first gear lives inside the way humans process uncertainty. In 1951, psychologist Solomon Asch ran an experiment. He showed subjects 3 lines and asked which matched a reference line. The correct answer was obvious. When the others in the room deliberately gave the wrong answer, 75% of subjects conformed at least once. Even when you can see the wrong answer with your own eyes, social pressure changes the verdict. In asset markets, the correct answer is far less clear. The less clear the answer, the more powerfully others' behavior reads as information. The second gear begins here. People receive the fact that others are buying not as a behavior, but as information. In 1992, economists Bikhchandani, Hirschleifer, and Welch named this phenomenon information cascade, a structure where people observe the actions of those before them, treat those actions as information, and abandon their own judgment. More simply, you are not buying because you analyzed. You are mistaking the fact that others bought for analysis. The key sentence of the original paper reads, "A cascade occurs when it becomes optimal for an individual, having observed prior actions, to follow those actions regardless of their own private information." For the individual, it is the rational choice. For the market as a whole, it is the moment when the sum of independent judgments disappears. Millions may point in the same direction, but the actual volume of information inside that movement could fit in a fist. When that fist loosens, everything pours in the opposite direction instantly. This does not live only in stock markets. Someone bought an apartment, a friend bought crypto, a colleague picked a specific stock. We do not hear these as rumors. We hear them as signals that others know something we do not. Amazon invested in Pets.com. Major venture capital firms poured in $110 million. Individual investors watched and concluded, they must know something we do not. In that current, other things became invisible. Like a company posting annual revenue of $620,000 while spending $11.8 million on marketing. November 9, 2000. 945 Bryant Street, San Francisco. Employees were arriving to receive termination notices. The office held only financial statements that bled with every sale and unprocessed debt. That afternoon, the company announced official liquidation. 9 months after its IPO, this was not only a retail investor's problem. Professional investors, institutions, all lived beneath the same instinct. Maintaining independent judgment against the direction a crowd moves means fighting the architecture of the human nervous system itself. When the market is a party, looking toward the door alone is hard. And this cascade has a particular fragility. It appears solid on the surface, but a single small crack collapses it instantly in the opposite direction. In the spring of 2000, one article in Barron's exposed how fast the major dot-com companies were burning through cash. That alone became the crack. In days, the cascade reversed direction, from buying to panic selling. But social proof instinct and information cascade alone cannot explain one thing. 400 years ago, exactly the same thing happened. February 1637. At the Amsterdam Exchange, a single tulip bulb sold for 20 years of a skilled craftsman's wages. The switcher's variety rose 30 times in 1 month. Semper Augustus, 6,290 guilders. By today's measure, a single flower worth hundreds of millions of won. Economic historian Earl Thompson did not read this surge as mass hysteria. The Dutch authorities had effectively converted futures contracts into options. Profit if prices rose, exit with minimal penalty if prices fell. The moment downside risk vanished, people had every reason to bet without limit. 3 months later, buyers vanished. Prices returned to pre-surge levels. A century later, the same variety traded at 1/10 of a guilder. 100 years was enough to erase 99.9% of the peak. December 29, 1989. The Nikkei closed at 38,915. 15 of the world's top 20 companies by market cap were Japanese. Serious voices said the Imperial Palace grounds were worth more than all of California. 38,915. It took 34 years to reach that number again. The stock a father bought at the peak did not return by his children's retirement. 400 years, 3 countries, 3 asset classes. The only variable was what people were excited about. Tulips, stocks, real estate. The formula never changed. So what completes this formula? The crowd converges. Their behavior looks like information, but it does not end there. The third gear engages, a structure where price itself becomes the new evidence. Prices rise. News appears. News appears. New people enter. New people enter. Prices rise again. George Soros called this reflexivity, a structure where price and reality create each other. Simply, the company looks good because the price went up, and the price goes up further because the company looks good. At the peak of the dot-com bubble, the Wall Street Journal wrote that the concept of profit was something to be reconsidered. Adding .com to a company name was enough to send its valuation skyward. Price made the narrative. The narrative made the price. Robert Shiller's Century of Data shows that every mania broke at points more than twice the historical average. At the dot-com peak, stock prices were 44 times long-term average earnings. The price tag was running far ahead of a decade's worth of profits. The same stock keeps coming up in the group chat. The algorithm keeps pushing similar videos. In the community, the voices saying it has already started drown out those saying it is already too late. If 9 of the 10 people closest to you say buy this today, what would you do? Most would think, right, I should buy. But if those 9 watched the same YouTube, were in the same community, shared the same news, it is not 9 judgments. It is one judgment copied 9 times. 3 gears lock together. Social proof instinct triggers the inflow. Information cascade dissolves the independence of judgment. The self-reinforcing price loop packages it all as fact. None of these operates alone. They mesh and turn together. While this mesh is running, those inside the party cannot see the view from outside. The higher the returns, the stronger the conviction. The skeptics look like a minority. That conviction manufactures the bill. The most dangerous thing at the party is not the price. It is not knowing which seat you are in. This formula is not a story from the past. In 2021, a single apartment lottery in Hwasong Dongtan drew 809 applicants per unit. The expected profit upon winning, hundreds of millions of won. 100 people in line, and that door looked like the safest one. In the same year in the US, 900,000 accounts flooded into GameStop in one day, all watching the same board, chanting the same slogans, reading the same chart. They were not making different judgments. They were confirming the same judgment to each other. The culture was different. The institutions were different. The asset class was different. The outcome was the same. The moment the most people were at the party was the moment the most people received the bill. So what was different about those who stood in a different position within this structure? It was not about how much you studied. It was understanding first that the structure, where consensus manufactures price, is designed to work against most individuals. That understanding was the starting point. The Dalbar Investor Behavior Analysis tracks 20 years of data. Over that period, the S&P 500 returned an average of 8.7% annually. The average individual investor's actual return, 2.6% per year. In 20 years compounded, the same principle that would have grown to 717 million won following the index barely kept pace with inflation in practice. The cause of the gap was not analytical ability, it was timing. The behavioral pattern of buying when prices rise and selling when they fall was the mechanism eating returns alive. Average holding period, 4.5 years. The market moves the crowd faster than the crowd can beat the market. In 2021, Sweden's Financial Supervisory Authority analyzed the full records of 75,900 GameStop traders. Of those who exited by year-end, 63% locked in a loss. Those who profited were the minority who entered first. What the last guests at the party received was not profit. It was what the first guests sold to them. Research by Fama and French, analysis by AQR's Cliff Asness, reveal a different pattern. Over the past 30 years, a strategy of buying undervalued assets the market had abandoned, while avoiding overheated ones, outperformed by an average of 5.5% annually. 40-plus countries, asset classes beyond equities, same result. In the seats everyone avoided, sometimes the cheapest price was waiting. What creates this difference is the time horizon. The crowd searches for the room where the party is loudest right now. The long-term investor searches for the room where the party has not started yet. Same building, different seat. In 1999, at the dot-com bubble's peak, Warren Buffett was not buying internet stocks. That year, his returns fell far behind the market. The press wrote that Buffett had fallen behind the times. But in 2002, after the Nasdaq fell 78%, Buffett did not receive the party's bill, because he had been looking toward the door alone. Markets have signals that appear just before the party ends. There are 3. First, the explanation becomes easy. At the time, even non-professionals were talking about .com stocks. When complex investment becomes something anyone can narrate, that is already the final stage. Second, dissenting voices are mocked. Why aren't you buying becomes, why are you wrong? As happened when Buffett refused .com stocks and was called a relic. Third, price becomes the only evidence. When it's rising, so I'm buying, gains persuasive power, price is no longer illustrating a narrative, price is generating one. When all three signals appear simultaneously, the party is preparing the bill. So when the party is loudest, the question you need is not about returns. First, is there any evidence for this price beyond the price itself? Second, are those who speak against it being mocked? Third, is the reason I'm buying my own judgment, or the certainty of those around me? If you cannot answer these three, you may not be an investor. You may be the last guest. 400 years have passed. From tulips to internet. From internet to meme stocks. The only thing that changed was what people were excited about. The formula never changed. The majority was not wrong. They were just late. Everywhere in the world, when the most people converge, a belief takes hold. This must be the safest moment. That belief helped us survive for a lifetime. In asset markets alone, that belief becomes the bill. There is a saying, be fearful when others are greedy. It sounds simple, but when you are actually inside the party, fear is hard to feel. The music is too loud, everyone is smiling. The signals were always there. The problem is seeing them from inside the room. If there are things you are currently certain about, one question remains. Is that certainty really yours? Or is it the shared response of 9 people who consumed the same source? Is the room you are standing in the loudest room at the party? Then only one question remains. Are you the first guest to arrive? Or are you the last guest sitting before a bill someone else left behind?